Alright, let's talk about forming a C corporation. Sherry is interested in investing in Copious Corp. She not only wants to invest her cash in the company, but also wants to contribute some property that the company can make use of. Copious Corp has 105 current shareholders and is interested in bringing in Sherry as its 106th. Let's find out how not only Copious Corp will calculate its basis in Sherry's investment, but also how Sherry, the investor, will record her basis in the stock that she acquired. Alright, entity tax is the most heavily tested component of the reg exam, alright? That's no secret, and a lot of people struggle with it, but I'm here to tell you this is not that complicated. The name of the game to entity taxation for reg is being able to understand the differences between the rules of C Corps, S Corps, and partnerships, alright? And specifically within those three, we need to understand the big four, alright? We need to understand the initial formation, i.e. the basis calculation. We need to know the rules for taxing these separate entities, and we need to know both the rules for liquidating and non-liquidating distributions. Okay, so let's start with the formation and the basis calculation of a C Corp, right? That's what we're talking about, okay? So I want you guys to get out a piece of paper, and on a piece of paper, I want you to write down corporation on one side and shareholder on the other. All right, and the reason we're doing this is because within the formation of a C Corp, we are going to need to understand both the basis calculation of the corporation and how any gains and losses will be recognized, if at all, okay? And we're going to need to do this for both the corporation as well as the shareholder. Okay, so these are going to be slightly different in terms of how they need to be calculated. So let's start with how the corporation will recognize any gains from the formation. And the rule here sounds a little bit more complicated than it actually needs to be, okay? The rule is that the shareholder will not recognize any gains or losses as long as the following exist, okay? So we've got the boot received and the 80% control test. So let's break down this rule, all right? Immediately after the transaction, if the contributing shareholder owns at least 80% of the voting stock and at least 80% of the non-voting stock of the company, and the contributing shareholder did not receive any boot in exchange for the property. Remember boot? Right, and for C Corp purposes, this is going to be things like cash, cancellation of debt, the receipt of any debt securities. And the last one is a little bit specific, all right? So this is also going to be a gain or boot that will be recognized if the amount of the liabilities assumed by the corporation exceeds the adjusted basis of specific property that is being contributed. Right, so let's break this down. Let me give you an example. So Sherry contributes property that is worth $100,000. That property still has an existing mortgage of $120,000 that Sherry has to eventually pay off, right? So the gain here to the shareholder, Sherry, is $20,000 because the debt is in excess of the basis of the property that is contributed, okay? So the debt associated with the property that she contributed is greater than its basis, right? AKA its net book value, okay? So boot is basically anything that is received by the shareholder in addition to the C Corp shares that they're receiving, and it provides any sort of economic benefit, okay? So the basis calculation of the corporation is what we need to know next. And the big thing to focus on here is how the corporation will calculate the basis of the property that has been contributed. Okay, so corporations are going to calculate the basis of the shareholder's contributed property as the greater of the contributed property's adjusted basis, aka the net book value, plus any recognized gain by the shareholder, all right? And we'll talk about that here a little bit more in a second, so stick with me. Or any debt that is attached to that contributed property. Okay, so going back to our example again. Sherry contributes property that is worth $100,000. That property still has a mortgage of $120,000 that Sherry has to pay off. So the basis to the corporation is $120,000 because it is the greater of the two. Okay, and here's the kicker. Let's go back to our gain and loss calculation really quick. Let's say that Sherry also received $30,000 from Copious Corp. Now, what's the basis to the shareholder? What did we say up here? Okay, so it is the adjusted basis plus any recognized gain by the shareholder. Okay, and it's going to be the greater of that amount or the debt assumed. Okay, so back to our gain rules. We are not recognizing gain if we meet boot, received, test, or the 80% control test. Okay, so, well, here we received boot. Okay, so we need to recognize gain. And how is that going to affect the shareholder? It's a gain. So we are going back to our C Corp calculation of basis of property received. We've got the greater of the adjusted basis plus any recognized gain by the shareholder. All right, so it's $100,000 now plus $30,000 gain that has been recognized, which is now going to be $130,000. And this is now greater than the debt received, which is $120,000. All right, so the answer in this situation is $130,000. So let's now talk about the shareholder. All right, so we already ran through how the shareholder is going to recognize gains, right? We said this could be the receipt of boot, right? So that could be cash, cancellation of debt, receipt of debt securities, right? If their contributed liability exceeds their basis. And how about the basis to the shareholder? This is going to be the sum of pretty much anything that they contributed in exchange for the corporate stock, all right? So this could be things like cash, and for quantifying cash, it's just going to be the amount that was contributed, all right? So this can also be property. What type of property? When in doubt, it's always going to be the adjusted basis of the property, all right? The net book value. And how are we going to measure or quantify cash that was contributed? It's just going to be the amount that was contributed, all right? So that's going to equate to the basis of the stock that they're receiving in exchange, all right? How about property? Well, when in doubt, always go with the adjusted basis, all right? The net book value of the property that was contributed. So the adjusted basis of the property that was contributed will generally equate to the dollar value of the stock that was received in exchange for it, right? So here's the kicker though. The adjusted basis will be reduced by any cash or boot received by the shareholder and any debt of the property that is assumed by the corporation. How about services in exchange for C Corp stock? The answer is yes, those can be contributed in exchange for stock, but here's the kicker. They are going to be valued at the fair market value, but it is also going to be taxable to the shareholder, all right? So let's say, for example, you're a lawyer. You are contributing 10 hours worth of litigation services in exchange for 10 shares of stock valued at $1,000, right? So we're saying that we would otherwise charge this amount of money for our services, all right? That amount that was received in stock, right, the $1,000 would be taxable as ordinary income to the shareholder in exchange for the stock, all right? So it's still going to be taxable, and this is going to be the only thing that will be taxable in exchange for stock. So remember that, that's important. Something also to note, and this is something that's kind of crazy that might get thrown in there, and if it does, it's kind of sneaky, but the shareholder who contributes only services is not going to be counted as part of the control group for purposes of understanding the 80% control test, all right? So they're not going to be incorporated within that 80% control test when it comes to measuring gains or losses. All right, so for one last time, back to our example. Sherry contributes property that is worth $100,000. That property still has a mortgage of $120,000. So we already calculated the basis to the C Corp, right? We said it was $120,000. But the basis to the shareholder is going to be what? This is going to be $0. And why is that? Because the basis to the shareholder can never, ever, ever be less than $0, okay? So assuming in this scenario, in exchange for this property, the final result will be a $120,000 basis to the C Corp, a $0 gain to the C Corp, and now we've got a $0 basis to the shareholder, all right? So Sherry, the shareholder, will be taxed on a $20,000 gain because now the company is paying off the debt on her behalf, all right? So $120,000 basis to the C Corp, $0 gain to the C Corp, $0 basis to the shareholder, and a $20,000 gain to the shareholder. Okay, so that sums up C Corp formations. Just know the three things that they could potentially ask you, all right? We have to know what is the basis to the corporation, what is the basis to the shareholder, and what is the recognized gain to the shareholder, right? If you could calculate those three, you're going to screech out with excitement at the Prometric Test Center when you see these questions hit the screen of that 1999 computer edition that they use at those test centers, all right? Hoorah! Let's move on to our next section.